Hi everyone, I'm going to lecture for a little bit on the last part of chapter 13. I told you that that I'd give you guys a walkthrough on deductions and so forth. So with regard to deductions, if you're thinking from a technical perspective of how the deductions are accorded per the Internal Revenue Code, there are actually 5 categories of deductions. And there's a chart on the first page under the deduction section of your text that speaks to the different IRC sections and the different categories of estate deductions. And the first category is funeral and administrative expenses and debts. And we'll talk a little bit about what kinds of debts. The second category are Section 2054 expenses, which are casualty and theft losses, something that you probably wouldn't see as much in practice. The third category are Section 2055 charitable contributions. And there are special rules about charitable contributions of estates that we'll go over. Fourth category are 2056 marital deduction expenses. We'll talk about the rules around those. And then the fifth category are 2058 state death taxes. So those are, and for all kinds of entities or persons, as the code will refer to an entity, a type of taxable entity as a person, and don't be fooled by that. A person, as defined in the code, can be not just an individual, but it could be a corporation, or a trust, or a state, an S corporation, or a partnership. So most persons are accorded a deduction for state taxes. However, federal taxes are, I would say, almost never deductible. We did, however, there are some exceptions for some states, and I'm trying to think of what state. I think Oklahoma might be a state where you can actually deduct federal taxes, but most states follow federal rules, and they therefore will not allow you to deduct federal taxes. Some states, now for federal purposes, I told you that you can usually deduct state taxes. Now some states will make you add back state taxes, and then other states will let you deduct all of the state taxes, and some will let you only deduct the state taxes that you paid for their state, for the return you're filing, and then some states will make you add back only their state taxes. So you have to look up the rules for the different state returns. And I'm digressing a little bit, but that just gives you a little bit of a flavor about the different rules that there are depending upon what kind of an entity is filing a tax return. So the first kinds of expenses that you would deduct on an estate return are the funeral and administrative expenses and debts. And when we talk about debt expenses, you would normally think that we're talking about interest on debt, because on a normal individual return or on a corporate return, it's the interest that you pay on certain debt that's deductible on that income tax return. But when we're talking about an estate return, we're talking about the actual debt that's left by the decedent's estate. So the example that they give in the book is a pretty good one, because it kind of walks through this first category of expenses. And at Ed's date of death, he owed a $75,000 mortgage on his residence. So that was the debt that he still owed on his home when he died. He also, his estate incurred $280 of interest that was accrued on that debt, on that mortgage debt, and $320 of personal expenditures charged to a credit card. Now, if you have $320 of personal expenditures charged to a credit card and you haven't paid the credit card, you haven't paid the amount due on the credit card, then those personal expenditures are equivalent to debt. So the estate's administrative expenses, excluding all those previously mentioned expenses, were $32,000. And then he had funeral expenses totaling $12,000. So under Section 2053, which covers funeral and admin expenses and debts, Ed's estate could deduct a total of $75,600, which is the sum of the $75,000 worth of mortgage debt, plus the $280 of interest accrued on that debt, plus $320 of credit card debt. So his total debt expense that he could deduct is $75,600, and then he could also deduct the $12,000 incurred for the funeral expenses. With regard to the $32,000 of admin expenses, those are deductible on the estate return as well, and they could also be deductible on the estate's last income tax return for the year in which they're paid, or you could deduct some on each return, and you would pick and choose on which return you're going to deduct those admin expenses, depending upon which gives you the better tax result. And we will talk more about that when we get to Chapter 14, which covers trusts and estates from an income tax perspective, and it talks more about how you actually comply and what you put on those returns. But just know for now that with regard to the $32,000 of admin expenses, you would pick and choose on which return you would want to deduct those. Now, the next category of expenses that we'll cover are charitable deductions, and that's covered under Section 2055. And the difference here, as contrasted with the rules on deducting charitable contributions on a corporate return or on an individual return, is that on an estate return, there is no limitation that you apply. So remember, on a corporate return, you're limited to charitable contributions not in excess of an amount equal to 10% of your corporate taxable income. And any excess charitable contributions that you made for the year that are in excess of that 10% calculation, you would carry over to the next year and until you can deduct them. And then in that next year, they would be subject to that 10% limitation as well. In contrast, on an estate return, there is no limitation. So effectively, you could end up reducing your estate taxable base down to zero and not have a tax on your estate return at all. And you could see that there's some planning around this as well that we could take advantage of, or rather that the decedent's estate could take advantage of, in that they could choose to donate as much estate of the decedent's estate as possible in order to drive the estate tax down to zero. And in some cases, that may have been what the decedent would have wished, is, maybe he was a dog lover, so you could contribute enough of his estate to PETA or to the Humane Society or some other charitable organization serving pets in order to drive his estate tax liability down to zero. Now, the second bullet with regard to split interest speaks to a more technical area of the estate provision in the code. and with regard to charitable contributions. And there's a good example that I want to walk you guys through, and it's actually covered here in the slides. So in a situation, here's a situation where interests in a property are transferred to both an individual and a charity. So in this example, Jane conveys to City Art Museum a remainder interest in her home, but she will have a right to live in it during her lifetime. And then Jane takes as a charitable deduction the value of the remainder interest on her Form 1040 at the time of conveyance. Now, conveyance means, the time of conveyance is in the year in which she actually contributes a remainder interest in her home to City Art Museum. That is the amount that she gets to take a charitable deduction for on her tax return, because it's considered to be, a donation, and it's being donated to a charitable organization, i.e. the museum. So in the year that she donates her remainder interest in her home to the museum, she gets a charitable deduction on her 1040. Then some years later, when she dies, the value of the residence will be included in her gross estate, but she will have an offsetting charitable deduction for the same amount. Now, you might be asking yourselves, why did she have to include the value of the residence that she, in fact, gave to the museum some years before her death? Why does the value of that residence need to be included in her gross estate? And remember, when we talked the other day, we learned that there are some exceptions to what would be includable or excluded from a gross estate. And when someone gives something to somebody else, but they keep a hold of some portion of that, so they have some right to it in some way, shape, or form. So in what they don't tell you in this example in the slides, which they do cover in the chapter, it's actually the same example, but it's just not discussed in as much detail in the slides. The rest of the facts tell you that what Jane did when she conveyed the remainder interest in her home to the museum is that she said, I have the right to live in it for my lifetime. So because she has the right to live in it during her lifetime, for rent-free, that is going to, therefore, that the value of that residence upon her death is going to still be includable in her estate. The good news is because she had actually willed that, not willed, but she actually gave during her lifetime the interest in her property to the City Art Museum, and after her death, the City Art Museum owns the residence free and clear. She then her estate receives the ability to deduct as another charitable contribution the value of the estate upon her date of death as a charitable contribution. So it's a benefit in that it could have nasty consequences if she had, let's say that she gave during her life, she actually gave her residence to one of her kids and said, I'm giving you my house and you're going to get it when I die, but for right now, I'm going to live in it rent-free because I need a place to live. Now, in that case, and I think we covered that example a few days ago, in that case, when she dies, the value of the residence is going to be included in her estate because it's a remainder interest, and we remember from what we learned the other day that in that case it's going to be included in her gross estate because she had some hold over that property during her lifetime, even though she had gifted it during her lifetime to a kid, one of her kids. So, and the bad thing about the way that she did it in that way is that Jane's estate is not going to be able to offset the inclusion of the value of that residence by a charitable contribution, because gifting it to your kid is not like gifting it to a charitable organization like the City Art Museum. So, so that covers really what a split interest is with regard to charitable deductions. And then the last kind of deduction that we're going to cover that has some rules around it are meritable deductions. So a meritable deduction is, and I think we touched on this the other day, a meritable deduction is where the surviving spouse is allowed a deduction for whatever is given to, let's say it's a him, by his spouse who died. And he is allowed an unlimited deduction equal, and so it could actually drive the decedent's estate down to zero, in that if everything went to the surviving spouse, then the estate of the decedent, the dying spouse, would be driven down to zero by virtue of this meritable deduction. And this is basically to mitigate circumstances where one spouse is still living and one spouse has died. They don't want it to, they don't want to cause the surviving spouse to have to pay taxes on the decedent spouse's estate. Now, in the case of a foreign spouse, the only way to get the meritable deduction is by the use of a qualified domestic trust in order to pass the property from the decedent's estate over to the surviving spouse, who is a foreign spouse. Now, there are 3 tests in order to have a meritable deduction be eligible. And the first test is inclusion in the gross estate. So the property has to be included in the decedent's gross estate in order for the surviving spouse to be eligible for a meritable deduction. And they say in the book, and this is obvious, if you're not going to include, if you have certain assets that are excluded from the gross estate of the decedent, then it doesn't make sense that there would be a deduction available to the surviving spouse, because that would be like double dipping. So the meritable deduction is, as I said, to mitigate and offset the detriment that the surviving spouse would have by having to pay tax, but only if the amounts that are transferred to the surviving spouse are actually includable in the gross estate of the decedent. So the example that they give here is with regard to a life insurance policy. So Gail dies. Gail's married to Al, and Gail's life is insured under a life insurance policy for which her husband Al is actually the beneficiary, but Gail's sister is the one who owns the policy, which happens sometimes, right? So you can imagine in this case, because Gail's sister owns the policy, the life insurance policy, and even though the insurance proceeds are payable to Al, the surviving spouse, Gail's estate does not include the value of the life insurance policy because her sister owns it. And because it's excluded from Gail's gross estate, because there are no incidents of ownership of that policy, then the estate does not get, there is no meritable deduction that would be qualified in this case. Okay, so the second test is the passing requirement. And that requires that the property that's passing to the surviving spouse must pass in a qualifying manner. And Section 2056 actually lays out the different types of qualifying manners of passing the property to the surviving spouse. One is through a will. Two is through the state. So if a person dies intestate, i.e. without a will, then the state and the state, by state law, the surviving spouse gets all the property, becomes the owner or the heir to all of the property of the decedent spouse's property. Then that's a qualifying passing of that property. Also through dower or courtesy rights, which we talked about the other day, and that's where some states will accord the surviving spouse an amount of property of the dying spouse that could be more than actually the surviving spouse was actually willed. And that's just to make sure that there's equality and that the surviving spouse has enough to live on. So some states will have those rules around dower or courtesy rights. So that's a qualifying form of passing for the purpose of testing this second test in trying to get the meritable deduction. Right of survivorship is another qualified form of passing. Also, a general power of appointment. And so that's where the decedent had a general power of appointment on a piece of property that he may not have had full ownership over, but he had the right to appoint. He had a general power of appointment, which gives him the right to determine where that property is going to go and how it's going to pass. That's almost like incidence of ownership. And so that actually is a qualifying form of passing that will qualify for the meritable deduction. And also a designation as the beneficiary of a life insurance policy on the decedent's life, then that, and the designation of the beneficiary would be the surviving spouse. That's a qualified form of passing. Third test is the terminable interest rule. And that requires that the recipient spouse's interest not be classified as a non-deductible terminable interest. So a terminable interest is essentially where the property is passing to the spouse, but there's some, in some way, shape, or form, the spouse is only going to have interest in that property for a certain period of time, and then the surviving spouse's interest in that property terminates, i.e. therefore it's called a terminable interest. And they give an example. They don't talk about it in the slides, but I actually like the example that they give in the book, and so let's go over it real quick. So Lewis wills a copyright with a 10-year remaining legal life to his wife, Tina. Okay, so that means that he gives a copyright per his will to his wife, Tina, and that copyright only has a 10-year remaining legal life on it. That means that when the legal life of the copyright expires, nobody is able to exert ownership over that copyright. It just goes poof. Okay, so that's one thing that Tina gets willed through Lewis. He also sets up a trust for the benefit of Tina, whom he entitles to receive all of the income semi-annually until the earlier of her remarriage to someone else or her death. So in other words, when he dies, Tina will have this trust where she will live on the income from that trust. And she will enjoy the income from that trust from the date of Lewis's death until the date of her remarriage or the date of her death, whichever comes first. And upon her remarriage or death, the property, the trust property, it gets distributed to the couple's children or to their estates. That's called a remainder interest. And even though both the copyright and the trust are terminable interests, the copyright is still eligible for the marital deduction because it's not defined as, per the code, as a non-deductible terminable interest, whereas the trust remainder interest is. And you can see the difference in that nobody else is ever going to get an interest in that copyright, but because it just goes poof after its 10-year remaining legal life. But with regard to the trust, if she remarries, the children are now going to get that property in the trust, and that's called a non-deductible remainder interest, and therefore that would not qualify for the meritable deduction. So those are the three tests that have to be applied in order to see whether a property transfer to a surviving spouse is going to qualify for a meritable deduction. So now we're at the point where we've talked about the gross estate, the items that are included, the kinds of income that are included in a gross estate. And we've also talked about the kinds of deductions that you can deduct from the gross estate. So once you deduct all of your eligible deductions from the gross estate, you end up with what's called the taxable estate. And then, so the next thing we're going to talk about is this next box here, which are adjustable taxable gifts. So adjustable taxable gifts need to be added to the taxable estate. And once you add those to the taxable estate, then you end up with what's called the estate tax basis, or the estate tax base. And the tax is taxed. You are taxed on the estate tax base. Now, your adjusted taxable gifts are actually the amounts to include in the estate tax base are the amounts which are at a value at the date of the gift valuation and not at the date of death valuation. So you don't revalue the gifts that were made during the decedent's lifetime. You don't revalue them at the date of death in order to determine the amount that you're going to add to the estate tax base. So that speaks to the second bullet there. And then thirdly, the adjusted taxable gifts are net of deductions and exclusions. So once you add the adjusted taxable gifts to the taxable estate, you end up with the estate tax base, and then you calculate your tentative tax. And you use the unified tax rate chart that I spoke to, which hopefully by now you guys have had a chance to look in your tax at the back cover. And I am hoping that you guys have the unified tax rate chart in your book somewhere. Mine, as I said, is inside the back cover of my book. And you guys are going to have to use this chart in order to solve your problems. I am assuming it's in there. Let me know if it's not, because that's something we need to make sure the publisher includes next time, and then I'll have to find a chart for you guys online. You should be able to find one, however, in irc.gov, right, in the IRS website, irs.gov rather. So the maximum rate, and I think I covered this last time actually, the maximum rate is 40% now in 2016 for any transfers over 1 million. So once you calculate the tentative tax, then you are accorded some credits in order to determine your ending estate tax payable. So what kinds of credits do you get? You get credits for taxes that you've paid on prior transfers. You also get credits for pre-1977 gift taxes. So remember, we have to include our pre-1977 gift taxes in our tax base. But then we get a credit for whatever we paid, whatever gift tax we paid upon when we did the gift transfer some years ago during the decedent's life. We also get a unified credit. We get to a credit for post-1976 gift taxes. And we get a credit for the state death tax, and we get a credit for foreign death tax. So in order to calculate the credit for post-1976 gift taxes, there's some steps, and this is covered in your book. We'll cover it here quickly in the slides, but it's you basically sum up all of your post-1976 gifts. Then you calculate the gift tax using the current rates. And then you reduce your tentative tax by the excess of the amount of gift tax that you calculated, or the gift tax actually paid in step one. So you get to, you actually, for post-1976 gifts, you actually get an actual credit on everything that was paid in the prior year, or the greater of everything that was paid, or if in the case where you actually paid at a gift tax rate less than 40%, you're going to end up with a credit, now wiping out all of the value. So in essence, even though you're including the value of your post-1976 gifts in your estate tax base, you won't be taxed on anything around those, because you'll get to use these steps to calculate what really should be the tax in today's amounts on that, and then you'll get to credit for those against your estate tax. The last thing is saying no reduction in tentative tax if the gift tax actually paid is greater than step 2. So what they're saying is if you actually paid more than the amount of, if your rate of gift tax, if your gift tax rate years ago when those gifts were made is actually greater than the gift tax now, you're not going to get to reduce a credit for that excess. But they also don't want to hurt you, so they give you an amount, a credit equal to at least the amount that you paid. But you're not going to get an extra benefit. So the unified credit, what is the unified credit? Once you calculate your estate tax base, to the extent that your estate tax base is smaller than the exempt amount, then you're not subject to tax. The exempt amount is also sometimes called the exemption equivalent or the applicable exclusion amount. And in 2016, the exempt amount equals 5.45 million. We talked about this the other day about how it's indexed. So it gets indexed, meaning it increases a little bit every year from the date when the law came into place. I think, wasn't it back in 2013? So it's been indexed every year since then. And remember, I asked you guys to read about the history around estate taxation on the first page of your text, because there has been a lot of history and changes around tax law around that. So if the exempt amount was taxable, what they're saying in this last bullet is that the tax liability would be equivalent to $2,125,800 in 2016. Now, how did they come up with that? If you look at your tax rate schedule, your unified credit amount for estate and gift taxes, and you look in the last line of the chart, which is for 2016, they're saying that your basic exclusion amount, i.e. your exempt amount or your exemption equivalent, of $5,450,000, and that's the amount that you get to. So if let's say that your gross estate, not your gross estate, but your estate tax base is $5,550,000. You get to lop off, you get to subtract from that. You're essentially only getting taxed on the excess over the $5,450,000. So you're only getting taxed on the excess $100,000. And they show that pictorially in this chart by saying that you will get a credit equivalent to $2,125,800 on an exemption equivalent equal to $5,450,000 on a 2016 estate tax return. So if your estate tax base is exactly $5,450,000, your credit against your taxes will be $2,125,800, and you will therefore not have any tax at all on your estate tax return. So you'll see this. You'll see this when you go through some of your problems. It's fairly simple, and just remember you got to use the charts. The exempted tax liability is called the unified credit. So the $5,450,000 is called the exemption equivalent, or the exempt amount, and then the credit against your tax is called the unified credit. And that's what actually reduces your tentative tax. And that's why it's called a tentative tax, because your actual tax liability is whatever it is net of your unified credit and those other credits that we went over a minute ago. Now, if your unified credit, your exempted tax liability is in excess of your actual tax liability on the estate return, you do not get a refund. You just don't pay any tax. And that's because this is not a refundable credit. A refundable credit is one where if you have a tax liability of $100 and you go through the refundable credit form, there's usually a form or a table to calculate what your refundable credit is. Like a child care credit, I believe, is a refundable credit, or is it the renter's credit? One of those or both of those I used to have on my individual return, and one or both of those is a refundable credit. I remember, because let's say my tax liability was $100, but my renter's credit, let's say that's the one that's refundable. You guys, I don't remember. You probably know that better than I do. Let's say the renter's credit was $200. Even though my tax liability is only $100, I would get $100 back in cash from the IRS. And that's because my tax liability was $100. I got a refundable credit of $200, and 100 minus 200 is negative 100. So I actually got cash back of 100. What they're saying here is that the unified credit is not a refundable credit. So if your unified credit, once you net it against your tentative tax, brings you to a negative amount, it just goes poof. You don't get any money back. The next thing we're going to cover is portability between spouses of the exemption amount. And this has, over the years, changed somewhat. But the way the rule works now is that any unused exemption amount of the decedent spouse's estate can, upon election by the executor, pass over or be portable to the surviving spouse's estate. The example that they give in the book, which is fairly easy and it's a good one, is this one. So Joe dies in 2011 with a taxable estate of actually 2.12 million. And I'm sorry, I think it was this is not a good, it's actually, they've changed it. The book actually is more exact. So let's just pretend that Joe dies in 2012 and he dies with a taxable estate of 2.12 million. And in 2012, the exemption amount was 5.12 million. So he has no taxable estate, right? Because his exemption amount of 5,120,000 actually completely wipes out his estate of 2,120,000. But remember, I told you that extra credit, that which really is equivalent to a unified credit against your tentative tax liability. But to the extent that tax liability is thrown into the negative, I told you that it goes poof. It's not a refundable credit. But in the case of a surviving spouse, upon election, it is actually transferable over to the surviving spouse's estate, so that when the surviving spouse dies, and in this case that's Joanne, that unused exemption amount of $3 million of her dying, her decedent spouse's, Joe's estate of $3 million, passes over to her estate. And so now, let's say she dies in the next year when it's, I'm just going to they ignore indexing in the example. I'd have to look up what it is. Well, let's say she dies in 2013. So in 2013, the exclusion amount or exemption equivalent is $5,250,000. So her exemption equivalent is increased by the $3 million that gets passed over to her under this portability rule. So now her exemption amount is $8,250,000 when she dies the next year in 2013. Now, if she remarries after Joe dies and her second husband also predeceases her, then Joanne cannot use Joe's unused exemption. So you only get one portability. If you marry 5 times, you don't get all of your decedent spouse's unused exemption amounts. You only get one. Now, another kind of credit that we talked about on the prior slide were credits for taxes on prior transfers. And so we're going to talk a little bit about the rules with regard to those. And those, this arises sometimes where, let's say Joe we end up paying some estate tax on Joe's estate, on his taxable estate. And some of Joe's property gets passed to his son, Bob. And Bob ends up dying 2 years later. So now we have to recalculate decedent Bob's taxable base. And we have to tax him on that. And it would be kind of unconscionable, right, if we were taxing the same property twice within a really close period of time. So what they've said is, provided that there's a pretty short period of time between the date of death of the first decedent and the date of death of the recipient of the decedent, the first decedent's property and his death, as long as the period of time is pretty short, i.e. less than 10 years, then there's going to be a credit of some amount that's going to be allowable on the second decedent's estate. And that credit is, it fluctuates and depends on how much time has passed between the two dates of death. So if the period of time that has passed is less than 2, then it's 100% credit. Now, 2 or less. But if it's more than 2 years but less than 4 years, then it's an 80% credit. If it's more than 4 years but less than 6, it's a 60% credit, and so forth and so on. So, and then if it's less than 10 years, it'll be a 20% credit. Once it's 10 years or more, the credit goes down to 0. So they're basically saying, hey, if enough time has passed between the date of death and the heir's date of death, then they're going to get taxed twice on that. But they do accord you some benefit when there's only a short period of time. Here's an example. So Mary dies in March of 2010, and all of the property passes to Deborah, her daughter. And then Deborah dies 6 years later. So all of Deborah's property passes to her son when she dies. Both estates paid federal estate tax, both Mary's estate and Deborah's estate. So Deborah's estate, the person who died second, can take a credit of 60% of the taxes paid by Mary's estate, since Mary died only 5 years previous to Deborah. So that's how the rule works. So once you calculate the tentative tax, which you use the tables for, and then you apply all of your credits that we just talked about, you will come up with the estate tax payable. And then you have to pay taxes. And there are situations where there would be a delay. There's in the amount of time that you're accorded in order to pay those taxes. It could be where you have an interest in a closely held business. So in that case, the estate would be able to make the payments of the estate tax payable in installments. Now, in order for that benefit to apply, the gross estate has to have included an interest in the closely held business in the gross estate, and also the value of the closely held business has to be more than 35% of the total value of the adjusted gross estate. The reason they do this is because if you have a closely held business, it could present some problems trying to come up with the taxes due under the estate, and so they're trying to give the business, the closely held business, which in this case amounts to at least a third, more than a third of the total gross estate, some time to come up with the money to pay the taxes. That's just talking about the types of wealth transfer taxes. We're not going to talk about gift taxes. That was a previous chapter, and we're not covering that in this class. We're covering right now estate taxes. And then the third type of wealth transfer are generation skipping taxes. And I don't cover any of those in the problems, so I'm not going to talk about generation skipping taxes. And then the last part of your chapter, there's actually there's two sections left. One are tax planning situations, and you guys should just read about those. I didn't necessarily include any of that in your problems, but it's a good idea to read about those. And then the last section, which really is just the last page or two of your chapter, is talking about filing requirements, whether you actually have an estate return to file. An estate return is filed on a Form 706. So the first bullet speaks to the fact that there is no need to file an estate return if your gross estate plus your taxable gifts is less than the exemption amount. So remember, your exemption amount is that 5.4 million for 2016. So like in the case of my dad, so my dad passed away recently, and I had to do his estate return, or I would have had to do his estate return if his exemption, his gross estate had been in excess of that 5.4 million, but it wasn't. So because it wasn't, I didn't even bother to file a 706 because I'd have to go through a lot of effort to fill out that Form 706, which, you know, it's got some pages to it, and you have to figure out what the gross estate is, and then you have to capture all the admin expenses, et cetera, to come up with the estate taxable base. And then once I come up with that estate tax base, I'm just going to drive it down to zero with the exemption amount, which in my dad's case was much greater than his estate tax base. So if you're going to come up with no estate tax liability because you know that your tax base is less than the exemption amount, they're saying you don't even have to file the form. Now, I mean, that's really the case in the case of like a 1040 or a corporate return. I mean, if you know you're not going to owe anything, technically you wouldn't have to file, but we do that. And there are several reasons why we do that. Number one, if it's an individual return, you might be filing just to get your taxes back. So if you had taxes withheld against your pay, and you receive a W-2 showing that you had $500 of taxes withheld, but you already know that your W-2 income is less than the sum of your standard deduction and your personal exemption, you know you're not going to have any tax liability. But the one reason you would file a 1040 is to get your tax back, that $500 of taxes withheld back, right? So that's why we normally file a 1040. Corporations have a corporate, they have a filing responsibility. Now, could the IRS come back and penalize at all if there's no tax liability? No, there's really not any provision. So if there were no elections that needed to be made by the corporation and there was no taxes withheld or no estimates paid, rather, and there are no informational returns like a Form 5471, which you include in a corporate return when you have foreign operations, which those carry very big penalties for failure to file those forms with the return. If there's nothing like that, then you really don't need to file an 1120, but to comply, most corporations would. They would file an 1120. Also, if you have carryovers of credits or you are throwing a loss, you have an NOL, you want to establish those NOLs. You also want to establish your statute of limitations, which is 3 years for federal purposes and 4 years for California. And you want to establish you want to start the clock ticking on that 3 years. So that's the main reason why you would file a form, even if you owe no tax. But they are saying that you don't have to file a 706 if you're less than the exemption amount. Your tax base is less than the exemption amount. However, filing is required if the surviving spouse wants to make the portability election that we talked about. So then you would have to file to establish that portability of the unused exemption amount. The due date of the return is 9 months after the decedent's death, and you can apply for an extension for 6 more months. Valuation. you can have a 20% penalty apply if the property on the return is valued at less than 65% of the actual fair market value. So that's a special penalty that could apply if it's almost like a understatement penalty. There are also understatement penalties under 6662 that would apply in a corporate sphere, where if you're understating income by more than 20%, you could have the understatement penalty apply. Now, in this case, if you're valuing your property at 65% less than, or less, 35% less than the actual fair market value, then you could end up with a 20% penalty. So that is the end of my slides, and I'm sure you guys, this music to your ears because this is the end of my lecture. I hope you guys are enjoying your week, and I'll talk to you soon. Uprise.